Good morning, everybody, and welcome to our latest webinar. A very warm welcome, and today we'll be talking tax. Thanks for choosing to watch us today on Zoom. It's probably better than being outside, as it's a very wintry day here in Scotland. My name is John Moffat. I'm a director at Benson Wood & Co, and we are Chartered Accountants and Business Advisors. We're based in Airdrie, North Lanarkshire. We work with many owner-managed businesses, and we provide business advisory, accountancy, tax, VAT, bookkeeping and cloud accounting services, and payroll services. So as I said, our webinar today is called Let's Talk Tax, and we'll be providing you with some free tax tips. It's a very topical webinar given it's the autumn budget this week. I'd like to introduce our speaker, who is Laura Duffy, who's an accounts senior with us, and also I'll be butting in at some stages with some practical advice. More on Laura. Laura, she's got a first-class honours degree in accountancy, and she'll soon commence her training to become ACCA qualified, and she provides tax, accounts and advisory services to a wide variety of clients. I'm going to really embarrass her and read out a fantastic testimonial we got recently for Laura. She'll not be expecting this. And the client has said they appointed Benson Wood & Co as company accountants recently, and he wishes he'd done it sooner because Laura's made his life much easier. And he said the system and people at Benson Wood are excellent, and Laura's helped them patiently becoming familiar with the systems, taking on a range of tasks expected of an accountant, and she's worked with quiet efficiency, queries and their inadequacies with professionalism and friendly calm, and we have no hesitation in recommending Laura to anyone looking for a reliable accountant. So I hope that suitably embarrassed you, Laura. Just some quick admin. We've got a Q&A box for questions, and we'll answer questions at the end of the webinar. So again, welcome to Let's Talk Tax, and the agenda for today's webinar is as per the screen. Laura will first of all deal with research and development, tax tips, then capital allowances, capital gains tax, corporation tax planning, and then on to more into the inheritance tax, personal side of things, some more personal tax tips, and then a topical subject, cars, particularly electric cars, and tax. So over to you, Laura, and to start talking about research and development.
Thanks for that, John. So as John mentioned, my name's Laura and I'm an accounts senior here at Benson Wood. So the first topic we're going to talk about is research and development. So small to medium enterprise relief was introduced in April 2000, and it was introduced as a way to promote innovation against the UK's small to medium sized businesses. So the scheme allows you to make a 230% deduction on qualifying expenditure. If your company is loss making, you can claim a tax credit worth up to 14.5% of the loss. Large company relief was then introduced in April 2002, and this was later replaced by research and development expenditure credit. So this is a tax credit, and from April 2020, the rate was increased from 12% to 13% of your qualifying R&D expenditure. SMEs will also claim large company relief on some subsidised expenditure, for example, grants, and work subcontracted to them from a large company. R&D for tax purposes takes place when a project seeks to achieve an advance in science or technology through the resolution of scientific or technological uncertainties. So I'll pass you back to John, and he's just going to give you a bit of practical advice on research and development.
Okay, thanks, Laura. Just to say on research and development, it's important that a professional expert claim is submitted for any research and development claims. At Benson, we've partnered with R&D experts to help us deal with any large and complex claims. And also to mention, HMRC have recently set up a new team to check claims, so it's even more vitally important that the claim is done expertly and professionally. So if you need any advice on this, please get in touch with us. I'll move you back on to Laura, who's going to talk about capital allowances.
Yep, so capital allowances. So you can claim capital allowances when you buy assets that you keep in your business, for example, plant and machinery or business vehicles. Businesses can currently take advantage of both the super deduction and annual investment allowance to reduce their bills. So the annual investment allowance allows you to deduct 100% of an item that qualifies from your profits before tax. You can claim an annual investment allowance on most plant and machinery. The new super deduction announced in the last budget launched on 1st April 2021 to help companies looking to invest in qualifying new plant and machinery. So this allows you to claim a 130% super deduction and also 50% first year allowance for qualifying special rate assets. Businesses can also benefit from the written down allowance in certain types of assets. So we would use this on items that don't qualify for the annual investment allowance, such as cars. So this allows you to deduct a percentage of the value of an item from your profits each year. The current rates are 18% for the main rate pool assets and 6% for special rate pool assets. Again, I'll pass you back to John just for a wee bit more advice on capital allowances.
Okay, so what I would say further than that is, as Laura has mentioned there, it's a very complex area in terms of claiming allowances on assets you buy for the business. So it's important that you plan your capital expenditure to get the best tax relief possible. And again, seek expert advice on that. So please chat with us about your capital investment plans, as I say, it's a very, very complex area. So I'll pass you back to Laura for capital gains tax.
Okay, so capital gains tax is a tax on the profit when you sell something that's increased in value. So it's only the gain that you're taxed on, not the actual amount of money that you receive. You also don't have to pay capital gains tax if your gains in the year are under the tax-free allowance of £12,300. Business asset disposal relief, formerly known as entrepreneurs relief, has a lifetime limit for qualifying gains of £1 million. If you plan on selling a business or a significant shareholding, it could reduce the amount of capital gains tax you pay to just 10%. And John, if there's anything else you want to add on capital gains tax?
Yeah, again, just in capital gains tax, just again, seek expert advice on it. We've dealt with a number of clients who have sold businesses recently, and it is a fairly complex area. So again, seek advice on that. The other one I would add in terms of capital gains tax is residential property sales. The rules changed last tax year, and these must be reported to HMRC within 1 month of the residential property being sold. In the past, it was just in the tax return they get reported. So it's very important that HMRC are notified accordingly and an estimate of the tax due is paid over. So again, we're available to advise on that matter as well. So back on to Laura for corporation tax.
So corporation tax in the UK is currently 19%, but for some highly profitable businesses, this will rise to 25% from April 2023. Corporation taxes are charged against the profits that a company makes, and there are various reliefs that can help to reduce the amount of tax paid. So capital allowances, which we've already discussed, is one of the key methods of reducing corporation tax, as it allows eligible expenditure to be written off against profits. Loss-making businesses can also carry back or carry forward a loss into another tax year, and this will reduce the overall amount charged. Again, John, if you want to add anything.
Okay. Just in terms of corporation tax, it's important with the changes of rates that we just plan the expenditure, but business expenditure within our control running up to that date because of the change in rates and because of the super deduction for capital allowances. So again, feel free to have a chat with us to go through that. Back to Laura, who's now going to go into some personal tax tips. Oh, no, sorry, inheritance tax, sorry.
Yep. So inheritance tax is a tax on the estate of someone who's died. So it's payable at a rate of 40% on estates worth over $325,000 at the date of death, but this may be affected by certain rules and reliefs. It can also become due on certain lifetime gifts of assets at a reduced rate of 20%. So generally, it's never too early to start planning for inheritance tax, especially if you have an estate more than the £325,000 threshold, or £650,000 for married couples or civil partners. So now I'm going to just move on to some personal tax tips. First one to look at is pensions. So individuals can contribute to their pension pots tax-free, providing they don't go over the £40,000 annual limit. So this not only helps future-proof your retirement income, but it also helps to keep you out of the higher rate tax bands. So ISAs, the allowance for ISAs for the 2020-21 tax year is £20,000, meaning you can generate interest tax-free up to this amount. Salary and benefits. Exchanging part of your salary for payments into an approved share scheme or additional pension contributions minimises your liabilities. There's also a wide range of tax investment options which can help reduce your liabilities, such as venture capital trust investments. Your personal tax allowance. So the standard personal tax allowance is currently £12,570, and this is the amount of income you can receive before you're taxed on it. This may increase if you claim marriage allowance or blind person's allowance, and it can also be reduced if your income is over £100,000. Next is dividends. So if you operate a limited company, you can claim dividends of £2,000 tax-free. Any dividends over this amount will be taxed depending on your marginal rate. So for basic rate taxpayers, they will pay 7.5%, and higher rate taxpayers, they'll be taxed at 32.5%. Finally, interspouse transfers. So you can maximise your capital gains and income tax rates and allowances through these exempt transfers if your annual income is between £100,001 and £125,000. And I'll pass you back to John if he's just to summarise personal tax.
Yeah, thanks, Laura. So a couple of things to mention: that the dividend tax rate, the Chancellor recently announced that from next tax year, these are increasing along with so by 1.25%, along with the increase in national insurance. So that's something to watch out for. So there's tax planning opportunities there in terms of maybe taking dividends out at a lower rate prior to that increase. I would also mention we've recently done a blog on our website, which is www.benson-wood.co.uk, and that is on saving tax for employees and directors. Now, the kind of things that can be done to possibly keep you out of some of the higher rate tax bands. So have a look for that blog on our website. So I'll now pass you back to Laura again for the last section, which is on cars.
Okay, so if you use a company car privately, you'll be taxed on this, and this is known as a benefit in kind. Tax you pay depends on a combination of your salary, the cost of the car, and the CO2 it emits. Also, if you use your own personal car for business purposes, you can claim business mileage at 45p for the first 10,000 miles and 25p thereafter. If an employee has to repay the cost of fuel used for private travel, HMRC provides advisory rates on a quarterly basis, and these rates are based on the engine size of the car. So electric vehicles, there's a number of tax benefits to driving an electric car, such as the benefit in kind tax rate of only 1%, and this will be increasing to 2% next year. Electric cars are also eligible for 100% first year capital allowances. And John, just back to you to finish off on cars.
Okay, it's just a couple of things to mention on cars that it can be a great benefit to employees. We've had a couple of clients recently who have changed their fleet of cars to electric cars. It's not only benefited the business, but it's benefited the employers. Their tax bills are quite a bit lower because their benefit in kinds are lower. So electric vehicles is definitely a thing to consider, a tax efficient method of investment and providing benefits to your employees. So I think that's all I've got to say on that. So I think we're on to any questions. Yeah, so I'll have a look and see if I've got any questions on. So Yeah, I've got one here. What are the rules regarding the sale of, so we mentioned residential property sales earlier and having to report to HMRC within a month. What are the rules regarding the sale of a commercial property? Laura, can you answer that one?
So the rules are different for commercial property. They haven't changed. You would still report that the same through your tax return, the same way you have previously. So there's no 30-day limit having to report this.
I would also add on the residential property that is to be notified to HMRC within a month, and at that stage we can only estimate what the tax liability will be on it, because it depends on the taxpayer's other sources of income for the year, but it also needs recorded in the tax return at the end of the year to finalise things. So there's a couple of times it needs reported to HMRC with regard to residential property. And the last question we have is there any benefit in kind in hybrid vehicles used personally? So yeah, we talked about electric cars and the benefit in kind rates only being 1%, increasing to 2% on the last price of the car. Hybrid vehicles are, again, they can be more tax advantageous than, say, petrol or diesel cars. The benefit in kind rates can be lower, but that is based on the mileage. So if they do more than 30 miles on a charge, the hybrid cars qualify for a less of a percentage applied to the list price of the car. Whereas if they do only less than 30 miles on a charge, which is quite common in hybrid cars, it's a higher benefit in kind percentage. Again, contact us if you need any more details on that. So I think that's all the questions for today. So please, I don't know if there's a next slide about getting in touch with us, Laura.
Yeah, there is.
Yeah, so Laura's email address, laura.duffy@bensonhyphenwood.co.uk. Our phone number, 01236756161, and our website, as I referred to earlier, benson-wood.co.uk. So thanks very much for joining us today, and we'll see you next month for our next webinar. Thanks very much. Bye.
Thank you.